All right, everybody. Welcome to my channel. My name is Cody Barton, and where you always are hearing about real estate, business, finance, different systems, topics. And I thought that this was probably one of the best times to do this as we're about halfway through the year in 2021. We have the Biden administration now in control, and there's, lots of chatter about what's going to happen with taxes and, chatter about, are we going to be paying more in taxes? Probably more, or are we going to be staying about the same? So I figured, there's no better opportunity than to get my good buddy, Dustin Griffiths, on a YouTube video with me, because he is, certified tax guy, my tax guy, and he has been helping me and my partner Pace out for the last couple of years. And so, Dustin, excited to have you on and, fill me in, because I know you've been studying the changes that are happening and, catching me up to speed on what's going on. But for those that are watching this as well, that are investing in real estate or investing in businesses and growing their businesses, what are some of these things that they need to be paying attention for? That's what we're going to be talking about in this video. So, Dustin, do you want to just kind of share just briefly about yourself, and we'll dive right in?
You bet. I'm Dustin Griffiths. I'm a CPA, certified public accountant. I've been doing tax work for the last 10 years or so, and really enjoy helping people keep more of their dollars, not give it to the government. Over the last 5 years or so, I've kind of fallen into the niche of real estate and really enjoy real estate. I like real estate myself. My dad's a developer, and so it's something that I've been around growing up, and it's just a nice place. And how does the tax code work for real estate individuals? So it's good, and Biden's plan is out there, and it's creating a lot of unknown and uncertainty and adventure in my life, for sure.
Yes. Well, let's dive right in. I know there's a few different things. I think as real estate investors, one of the first things that I think of is, like capital gains. Like, is that something that's going to be changed? I've seen a lot of chatter about that, and I don't really know what is true and what's not true. There's a lot of theoretical, well, they might be trying to propose this, and so what's actually going on, or what are you hearing and seeing?
So the proposal right now is, and just kind of as a baseline, there's kind of two magic numbers with Biden's tax policy. One is 400,000, and that's annualized annual earned income for taxpayers, and the other one is $1 million. And so under what I've been able to read and pundits and other, frankly, large accounting firms who do analysis and law firms that I've read, what they're looking at is for the long-term capital gains, the current tax rates are a preferred rate, meaning they're lower than an individual tax rate. And typically that's going to be anywhere from 7 to 17% lower. Under Biden's policy, the long-term capital gains for individuals who earn over $1 million in a year will go back to the ordinary tax rate. So right now, current tax law, the top long-term capital gains tax rate is 20%. Under Biden's new policy, if you've earned over $1 million and you have long-term capital gains, those go back to 39.6%.
So 19+% increase?
Yeah, on long-term capital gains and certain dividends, which is what I would, it's what's called qualified dividends. Basically, stock that you've earned for a certain period of time and they're kicking out dividends to you, those would be included from what I understand. So if you're making more than $1 million and you're selling a lot of assets, you're going to get hit with higher taxes.
Ouch. Okay. Yeah. Well, what is that on the 400,000 plus range? Is that changing for above 400 but below $1 million?
No. So right now that 400 works with a bunch of other things, child tax credits, business flow through deductions, items like that is where the 400,000 is going to play more of a role. But the capital gains tax rates are all about $1 million.
Okay, so capital gains, people only need to be really worried. As far as right now, obviously things can change, but they only really need to be worried if they're making over $1 million a year. Correct. I mean, even over 400, you're not really having to worry about that yet. Or under 400, it's pretty much going to stay the same for capital gains, it sounds like.
Yeah. So really for long-term capital gains, under $1 million stays the same. That's what it currently sounds like. Currently, that's what I'm advising clients. So if you're thinking you're going to be over $1 million, that's where you need to do planning and make sure that you're on top of it and timing when you're selling certain assets or making sure that you're doing other things to keep you underneath that $1 million bracket. I mean, that's 20%. That's a sizable increase in tax. Yeah. And if I can do something and save that 20%, and I'm going to plan on doing it anyways, let's save the extra 20% for sure.
Yeah, that makes a lot of sense. So for those under 400,000, not really a big deal there. What are some of those things, I guess, for a lot of people that are listening, especially on this channel, may not be in that 400 or, $1 million plus bracket yet. What are some of the things that they're, that regardless of, where kind of the income is, they're going to be seeing some of those changes. I remember seeing some stuff about estates, 1031s, what's going to be happening with those.
I've got some notes written here. And so to keep myself organized, I'm going to hit down through my notes.
Let's do it.
So for individuals that are that $400,000 limit makes a difference for individuals with what's called the 199A deduction or the 20% pass-through income deduction. This applies to people that have partnerships or S corporations that they're owners in those, and they get income from those companies. Mm-hmm. Currently, they can take up to a 20% deduction on that income that flows through. Well, under the policy, they're going to Biden's policy from 400,000, and I didn't read the upper limit, but I'm guessing 500,000. That starts to phase out, meaning I'm no longer at 450,000. I'm probably only getting a 10% deduction at max, and at 500,000, I get no deduction on that flow through. And so understanding and playing with what you're doing with your business income will make a difference to make sure that you're still going to be eligible for that extra 20% flow through deduction. And that's, I mean, we're talking if somebody's got 400,000 of flow through income, that's an $80,000 tax deduction. That's probably 25 grand in taxes is what that's costing if that goes away for someone. So I'd watch out for that. 1031 exchanges. This is one of the bigger ones that I feel like is going to wreak havoc over a long period if it passes. Current tax rules for 1031 exchange, what it allows is it allows you to trade one piece of investment real estate for another piece of investment real estate and not pay taxes on the gain. So an example, let's say I bought a rental property for $200,000 10 years ago. And it's now worth 400,000. If I do a 1031 exchange and I sell that first piece and I buy another piece of investment property, I don't have to pay tax on the $200,000 that I basically gained over that 10-year period. And what happens is people will oftentimes continue to do 1031 exchanges throughout their life. And so they might have started with, again, a $200,000 property, and they're going to end with a $3 million property over their lifespan. The current tax rules, there's no limit on the amount of 1031 exchanges you can do. So if I had 15 rental properties and I wanted to do a 1031 exchange and put them all into a commercial strip mall, I could totally do that and there's no problem. And I could defer tax on $5 million worth of gains. Under Biden's tax policy, they're going to limit that to up to 1 million for a married couple or 500,000 for a single individual. That's the most you can defer in a year. So if I have a bunch of real estate that I'm looking to quote unquote trade up, I need to be careful of that because I'm limited on how much I can trade up in any given year.
That's not very much. I mean, 500,000 as a single individual. I mean, that's in some markets, that's one house.
That is. And if you bought at the bottom right after 2008 and you're trying to sell now, you're probably out of that, right? Yeah. In one property, it can be a real problem. Watch out for that. The other main thing that I think people need to be aware of and be aware of now as opposed to later is the estate exclusion. currently what happens is we have what's called the estate exclusion, which is when I die, a certain amount of assets go to my beneficiaries tax-free. Right now, I think this year it's just over 11 million.
Can go tax-free?
Can go tax-free to my kids, let's say.
Yeah.
And so let's say I had $10 million worth of property and $1 million in cash. My kids would get all of that without paying any taxes. Okay. Biden is proposing taking that back to 3.5 million. And so, 10 million, there will be a decent amount that will hit that. 3.5 million, significantly more individuals will hit that limit.
Yeah.
One other thing that Biden has slipped into the estate exclusion and gift taxing areas of the tax code is when I leave a piece of property to my children, they get what's called a step up in basis, which means they inherit the property at current fair market value. So to the example of a 1031 exchange, if I started with a property worth 200,000 and I 1031'd all along the way to a property that's worth 3 million when I die, my kids inherit that property valued at $3 million. And that difference between the 200,000 and the 3 million is what I'm using my estate exclusion to basically cover the tax burden on. That 2.8 million would be deducted out of my 11 million. And so that's how there's no tax occurring on that. And so my kids get that property, and let's say they don't care and they just sell it that day for $3 million. They literally pay no taxes. Under Biden, again, he's removing that from 11 million back to 3.5 million, but he's also limiting the ability to take a step up in basis. In the analysis that I have read, that step up in basis is going to be limited to, I believe they've talked about $100,000 per instance per person. And so if I've got $2.8 million of deferred gains and I die and I've got 4 kids, they're only going to be able to receive a $400,000 step up in basis, which means they're going to have to cover the tax on, what is that at that point?
The 2.4?
Yeah, the 2.4.
So going from paying no taxes on that to
paying tax on 2.4 million. Yeah.
So what you're saying is the entire time that you're living, you paid your income tax, you paid your state tax, you paid your car tax, you pay all these taxes, and then you've paid all the taxes on your money that you earned to then buy the property that you paid property taxes on. And then when you die, then they're charging a tax because you died to your family.
Almost. The one clarification on that is I paid tax on the 200,000 that I used to originally buy the property. Okay. But then I did 1031 exchanges all along the way. And so I never paid tax on those dollars. And that's where they're coming to get you.
So they want to get that. They want to get that, in that example, that 2.4 million and get the taxes on that.
Yep. And that
has that already came into place, or is that something that's just being talked about at this point?
It's just being talked about at this point. It's just part of his policy. And so we'll see what ends up happening. But in this example, if it was 2.4 million, your kids would be footing a tax burden of $480,000 to the IRS. And that's on the low end.
Ouch.
So yeah, it can be pretty brutal. So we're hoping that that is not going to happen. And I think we have enough congressmen who have enough wealth that don't want to pass that tax burden down to their kids that we're not going to see that happen, but you never know. Right?
Yeah, we'll see.
Yeah. So those are really, frankly, the big things. There are some other things that are happening. Trump took the very top tax bracket from 39.6% down to 37%. So just a very small decrease. Biden's going to put that back to 39.6%. And that is, like this year, that top tax bracket isn't until $628,000 of income for a married couple, or $314,000 for a single couple, or a single individual, not couple. So you watch out for that. If someone's listening and they're a really high earning W-2 individual, they're going to have to pay more Social Security and Medicare tax. So what happens is right now, Social Security and Medicare tax is limited to the first about 140,000 of wages that you take. After that, you only pay Medicare tax. You don't pay Social Security tax anymore. What Biden's going to introduce is over 400,000 of W-2 earnings are going to be subject to Social Security tax again. So it kind of creates this donut hole, right? Where I pay Social Security on the first 140, and then I don't from 140 to 400, and then I do again on 400 and above. So if somebody's a really high W-2 earner and they're investing in real estate as well, they have to watch out for additional Social Security tax that they might get assessed.
Mm-hmm.
Okay.
Wow.
So those are the main primary ways that Biden is looking at increasing tax.
Mm-hmm.
I just want to spend, if it's okay, just a couple of minutes on some of the things that he's doing in terms of tax credits that are.
Yeah, let's do it.
Okay. So the first one is he's increasing the child tax credits. Up to this point, kids under the age of, so under 17, so up to 16 are worth $2,000. What he's going to do is he's going to make it so that children up to age 6 are worth $3,600, and from age 6 through age 17, they're going to be worth $3,000. So if you've got kids, you get extra tax credits there. Those don't phase out until over 400,000. So that's another 400,000 limit. The dependent care credit. So if you're having to pay somebody to watch your kids so that both you and a spouse, or if you're single, so that you can work, basically both adults have to be working in a relationship. They've increased that tax credit so that it can go up. He has talked about implementing a first-time down payment tax credit for first-time home buyers up to $15,000.
That's interesting.
Subject to income limitations. So if you've rehabbed a property and you're looking to flip it and you're going to sell to a first-time home buyer, you might be able to get a little bit more, you might be able to get a little bit of a higher price out of that because they're going to be able to get some tax credits on the back end.
You know what I think is interesting about that is they're giving that opportunity for buyers in a market that's already a really hot market right now. There's low inventory, not enough homes for sale, literally a home shortage, really across the nation right now. And I would have thought there'd be some sort of like seller credits or something to incentivize the sellers to sell their properties versus, no, we're going to increase capital gains so it's harder to sell your property to justify it. And then we're going to make it, more desirable for the first-time buyers to buy by giving them a credit. So it's just squeezing the market more. I mean, it's just like adding fuel to the fire, I think.
It totally is adding fuel to the fire. It's going to be, I'll be honest, I hadn't thought about it in that exact scenario, but yeah, that it's just going to make it so that there's that much less inventory, which means guess what? Construction costs are going to stay high for a long time if that's the case.
Yeah.
And
so has that came into force yet, or that's another conversation piece?
So all of these things that we're talking about are things that are proposed
right now,
but it hasn't happened yet. He's looking to restore the fully electric vehicle tax credit. So right now what happens is, for instance, Tesla has sold enough cars that under the current tax rules, if you go out and you buy a Tesla, you don't get any tax credits for it anymore. And so it sounds like he's looking at putting that back into place so there isn't a limit. Once a manufacturer has sold enough cars, the tax credit goes away. And so it sounds like he's trying to bring that back. He's also talking about permanently extending the solar tax credit. So right now, the solar tax credit, if you install solar on your home, it was 30%. This year it's 26%. Next year it's 24%. They're phasing it out over the next couple of years. He's talking about extending that and making it fully or making it permanent rather than having it phase out. So people want to do solar, they can do that, and there are tax credits associated with that. He's talked about a rental or a renter's tax credit. In certain areas, he's talked about a credit that will allow the cost of rent to not be more than 30% of the median income in the area or in the community. Now, I haven't been able to get details as to, is that a credit that the renter will get, or is that a credit that the property owner will get? And I don't know the answer to that yet. But let's say I've got a rental in a depressed community, I might be limited on the amount of rent that I can officially charge, and again, how that's going to work
nationwide.
That is nationwide from what I hear, what I've been able to read. So if you're rehabbing properties or holding them as rentals, just be aware that something might come down the pipeline in terms of a renter's credit, and we don't know which side it's going to happen on, the renter's side or the property owner's side. One other one that he is looking at expanding is what's called the opportunity zones. Right now, if I sell an asset and I have capital gains, if I reinvest that money into depressed communities, I don't have to pay tax on that capital gain right now. What I can do is I can wait. If I reinvest that money and leave it in that depressed community for 5 years, I get a 10% reduction on the amount I have to pay tax on. If I leave it an additional 2 years, I get an additional 5% deduction. So I can receive a 15% deduction on my capital gain if I invested in an opportunity zone and for a long enough period. That happened during Trump, but that stops as of the end of 2025. So right now, if I sold a capital gain and I invested it into an opportunity zone, I wouldn't get anything out of it because I couldn't leave it in there for long enough. Mm-hmm. And so Biden is trying to extend that. So that might be a good thing for real estate investors. Sell properties in really affluent areas or high gain mm-hmm. areas and reinvest it in more. And when I say depressed communities, I'm not talking slums. Like I live in the Salt Lake City area, and it's called Magna. It's a city that's about probably 10 miles out of downtown Salt Lake City. It's not a horrible area, but it's certainly an older, lower income type area, and that's considered an opportunity zone. So I could reinvest in Magna and find an area that has some nicer homes and invest there and defer a gain, right? So that's one thing he's talking about. The last one that I want to touch on that he has talked about is what's called the I call it the rehab tax credit, but I think the official name is the Neighborhood Homes Investment Act. Basically for development or rehab of properties in economically depressed areas. He's talked about giving a tax credit. Now, from what I have read, and there's a website you can go to. It's neighborhoodhomesinvestmentact.org. They have a little executive summary, and this comes directly off of their executive summary. So they're talking about giving tax credits for people that are going to rehab homes in these areas. This is the example that they give. I acquire a property for $50,000. I spend $150,000 on rehab. So I'm into the property a total of $200,000. Because of the way that the credit is going to work, you can't sell there's an upper end limit on the sales price. And this example gives the $160,000 as the sales price. So really I'm upside down in the property by $40,000.
Plus other costs.
Yeah. And so the tax credit at this point gives me or makes me whole. It would give me that $40,000 back, and that would be my tax credit. And so I guess as I think about this and kind of talk through this a little bit, if I have significant income elsewhere without a lot of deductions, that's not a bad thing. A $40,000 tax credit is a dollar for dollar reduction in tax. What doesn't make sense to me is I'm out 40,000 actual dollars. So
yeah.
All the credit is doing is making me whole. And
it's
so
like you're not paying that 40,000 to the IRS, but you just basically lost it
on the deal.
So what makes more sense, losing $40,000 at the casino or losing $40,000 flipping a property that you lose 40 grand on.
So in that example, the only difference is I'd want to lose it on my rehab because the IRS is going to make me whole on the back end. If I lose it gambling, SOL, right? So that seems to be it. And so in my mind, as I've kind of read this, the reason to do something like that is if you want to build good brand awareness or goodwill within a community, this might be a good way to go about it, right? Cody Barton is out there and he's doing rehab and he's making homes really great for low income earners. And Cody's wonderful because
helping restore this community in the area. And, so maybe that makes more sense for like really high income individuals that are trying to, build a presence in an area, I guess.
That's right. And maybe, or maybe, your track home developers, right? I know locally here, Edge Homes or Ivory Homes, they do large tracts of homes, right? And big developments. And so maybe they would go into an area that they're going to put a development just on the outside of this economically distressed area, but they're going to go in and do some rehabs to build good value or good brand awareness and goodwill with the community. That might work.
Yeah.
Right? But otherwise, I don't really see a lot of benefit in that credit. So it's something that's talked about, and maybe there will be more clarification that will come out, right? Some of this is we're just waiting to see. It's got to go through Congress still, and they're going to hammer out a whole bunch of things. And so I expect things to change, but this is where we're currently sitting at and what we currently know.
So I guess kind of in closing, Dustin, I mean, what would you say for those that are, let's just stick with real estate investors, for now, if you're talking to the real estate investor crowd, what would you be doing to kind of, what would you recommend to be kind of getting prepared for, some of these things to come in place? Are there certain action items you'd say that you should be doing, for maybe some of the newer investors or even seasoned investors, just to make sure they're set up for, some of these potential changes?
So I think for real estate investors, the biggest one is we just got to watch the 1031 exchange rules and what happens with those, right? If I have a significant amount of real estate holdings, and I'm talking let's talk even more than the 10 million current exclusion, I potentially want to set up an LLC or what would be called a family limited partnership, work with an attorney to get it set up. But it's an entity that I could put my kids on and start giving them ownership of that right now, which allows me to reduce the amount of the estate exclusion that's going to happen when I die, right? And so there's strategy in estate planning to make sure you're not going to be, your kids aren't going to be left with a huge tax burden when you die if you have a significant amount of real estate. So I guess that would be one. Two, watch the 1031 exchange rules. And if you've been thinking about doing a 1031 exchange, right now, Biden's laws haven't been passed. That doesn't mean that they won't be passed and won't be made effective for 2021. But if it's something you've been thinking about and wanting to do anyways, it does not hurt to try to do your 1031 exchange now, with the hope that if Biden does pass his reform, and that is one of the things, that isn't effective until 2022. And so getting that 1031 exchange done now where you can defer all that tax is not a bad thing. I'd say
so taking action sooner than, waiting it out and seeing what happens. If you're already going to plan to, thinking about doing it, probably just do it and, get it moved on.
You got it. So those would be the things that that's what I would watch out for.
Awesome. Well, Dustin, thank you so much, man. It was great having you on here. I know, for myself, I always like learning from you and, hearing what's, going on, because this affects all of us. And for those that are watching, like the real estate investors that are watching, the small business owners that are watching, everybody's, is looking at taxes, how it's going to affect them. I mean, even some of the points you made on, W-2 earners, as there's a lot of W-2 earners that watch this channel that are, trying to transition, it's going to affect them as well. So really appreciate it. For those of you that are watching, make sure to, if you've gotten any value from this, make sure to like, subscribe, hit that notification bell. And as always, we'll see you in the next video.